without a doubt. Up next on the program, ushering in a new fiscal era.
We will make this moment a circuit breaker for Britain, bringing a new political model and a new economic model.
Up next, Jane Foley of Rabobank, live from New York, watching Bloomberg TV.
Well, mentor Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. It doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the third floor or the lobby. You actually have to start in the basement.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
They're rich far. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insights with Haslinda on it, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
So here's the bounce this morning, up 0.5 on the S&P, up 1.4 on the Nasdaq. On the Russell this morning, higher by 0.7 in the bond market. Some stability. 2s, 10s, and 30s. Stateside look like this. 10s around 460. 10s in the UK. Some jitters in the last 24 hours, north of 5. Let's talk about the UK. Under surveillance this morning, ushering in a new fiscal era.
We will make this moment a circuit breaker for Britain, bringing forward the biggest changes in the last 40 years. A new political model and a new economic model.
So here's the latest this morning. The UK Prime Minister Andy Burnham naming former Defence Secretary John Healey as Chancellor of the Exchequer, fueling speculation for increased military spending. Jane Foley of Rabobank writing the following: against the backdrop of an already high tax burden and a squeezed fiscal position, we see risk that market optimism will have started to run dry by the autumn. Jane joins us now for more. So Jane, welcome. Let's park the vibes. Let's focus on the policy and let's focus on the structure of this UK economy. What is it about the British economy that leaves any leader right now in a position where they face imminent failure?
Well, of course, the debt is, as a percentage of GDP, nearly 100%, just a little bit lower than that. And of course, you've got to think about the structure of that market too. The UK has a very low savings ratio. It's got a current account deficit, and that makeup can make the debt market really quite jittery, more so than other markets that are perhaps insulated by a high proportion of domestic savings. So the gilts market in the UK can be jittery. I think you know the history of Bliss Trust. Some commentators would say, well, there's been premium on gilts since then. There have been, long memories perhaps in the markets. And we're worried. We're worried about Burnham, how he can fund his plans, because what we've effectively got is a government that's moved further left. Now, Burnham has said that he will stick to those fiscal rules set by Rachel Reeves, but even that, there's a little bit of woolliness about that. He said yesterday he would use flexibility, and that might mean that he would fund perhaps some of those infrastructure projects he wants to do by putting that debt on the books of maybe public financial companies. So the market's trying to figure this out. Where is the money going to come from in order to finance his plans?
Well, let's talk about one dimension of policy. Let's discuss energy. So, Jane, there is the North Sea oil. Let's say we have a different perspective on North Sea energy in the UK. And let's think about what that could mean for the balance of payments position of the United Kingdom and the potential tailwind that might provide for sterling over time. How do you, as someone in the FX market right now, think about that?
Well, I'm no energy strategist, but what we've been told for years is that a lot of the cheaper reserves from the North Sea are depleted anyway. And of course, you've got to go back to the 2024 Labour Party manifesto. And, Burnham has said that he will maintain that. And that means no new licenses. So what we're talking about potentially under Burnham is a sort of a stretching of existing licenses to use that. But again, you have like the eco fund. The UK has actually been ahead of many other countries in Europe, or most other countries in Europe, in terms of taking out coal, in terms of burning that to use electricity. We use less gas than some of our other Western European countries too. And a lot of people would still argue, well, you know what, we need more investment in nuclear, which is coming, but clearly that takes a long time. And we have stepped up, wind, for instance, solar, etc. And there's a lot of pressure, as we all know, on Europe in particular, to get that right. And there has been really since 2022.
Jane, what's different than the Starmer policies? Some of these just sound like repackaged Starmer policies with a different CEO at the top.
Well, we need to wait for detail. Now, the things that he really is talking about perhaps is trying to unleash productivity from some of the northern towns. Now, you could say that would be a great solution, because if you look at the UK, London, the Southeast, really productive place. But if you go elsewhere in the UK, well, you do not get that. So you could say, yeah, you need that investment to really unleash that productivity. And productivity, if we were to get it here, would really be the answer to many of our problems. We'd have greater wealth, we'd have greater, growth, for instance. That would really, really be helpful. The problem is, we all know it can take 10 years or so to really make infrastructure investment work. He's got 3 years to the next election. And this is where it gets really tricky, because if you look at the opinion polls are suggesting if there is an election right now, well, the country would vote reform, which is right. And right now, the Labour Party is sort of neck and neck with the Tories, which is a centre-right party. And as Tony Blair pointed out in his essay a month or so ago, well, it's unusual, isn't it, that when the electorate goes right, the Labour Party thinks the solution is to go further left, which is where Burnham comes from.
Let's see if they wait 3 years for that election. Jane, thank you. Jane Foley there of Rabobank. Sterling this morning at 134, the UK with its own problems. Coming up next on the programme, Emily Rowland of Manulife, John Hancock Investments. We'll catch up with Ariana Salvatore of Morgan Stanley, Ted Morrison of Baird, Joe Davis of Vanguard. The second hour of Bloomberg Surveillance is just around the corner.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsel as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization as well.
Well, we did announce our tokenization initiative earlier this year. Already built the technology, buried on a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but it is going to be a platform that runs in parallel to our more traditional exchanges.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Matei.
I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas, where it's really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have to bet it. We got a big week coming up in politics.
Spring season is underway. We get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Hi, buckle up.
I think that the consumer is displaying real resiliency. Yields are quite attractive.
I think the Fed will eventually end up on the side of not tightening.
That maybe they hike, maybe they don't. The orthodox policy response to a supply shock, but nipping through it.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and the price action the scores look like this. Equity futures bouncing back from 3 days of losses on the S&P, up by 0.5. Outperformance in the tech sector on the Nasdaq this morning, up by 1.4. In the bond market, some stability after twos closed above 420 again in yesterday's session. We hold that level this morning, 420.21 with crude. Been volatile. Brent and WTI. Brent still elevated 90 and up 1%. WTI 84 and up 1%. And we face significant two-way risk working through this week.
So the two-way risk is on one hand, potentially there's a 10-day ceasefire that's floating out there. And there's some encouraging reports this morning that Iranian mediators are in Pakistan to discuss potentially this off-ramp. The other risk is the strikes continue, and already we hit 10 days of continuous strikes from the United States and Iran fighting back in terms of going after U.S. military installations and some desalination plants of Arab partners, and also another choke point in the world for global crude potentially getting hit if the Houthis decide to get involved.
Escalation on the table in the last 24 hours. The middle option, the messy status quo, comes with its own problems. We've caught up now with countless professionals in the energy market. We're making the point, stop looking at the price of crude, look at the price of product, look at the level of inventories, and think about the problems that can materialize in the months to come if this situation continues.
There's already problems right now today when it comes to that product market. You see this in the United States with $4 a gallon, peak driving season. Potentially it's only going to get worse. What is going on in Russia? They have a diesel export ban right now.
China, yes, as Francisco was talking about, we talk about the soft imports there's been on crude. But when it comes to the actual product, they are hoarding. This is where the problem is right now. And this is why Jeff Curry says, stop with the noise on Brent and WTI. That's not where the act.
I think the audience just like stop with the noise. I can feel it every time I look down at Barrett of the camera and talk about this story. People throw their breakfast at the TV screens, throwing their smartphones on the floor. We've heard it all before. We don't care. It doesn't matter. It hasn't mattered over the last 7
Well, would you rather than us talk about tariffs this morning?
Let's
Because
not.
that's happening once again as well when it comes to Canada.
50% on the table for Mark Carney and the crew up in Canada. Where did that come from?
From milk, hockey sticks,
The hockey stick gets just
beer, plywood. The hockey sticks is a massive troll, clearly.
crazy.
But it is potentially, I think, this is more of a negotiating tactic. They don't even come into place for about 30 days after the president signs them. They are in the middle of USMCA discussions. It is interesting, as you said, the timing. They just had this wonderful outing together to watch the World Cup
It's a
final.
fantastic day, the perfect one, right? We'll sit together, plan happy families, then bang, following day, tariffs. Now, I get it. You don't care because the earnings have been so good and the earnings have been absolutely fantastic for Q1 and potentially Q2 as well. We'll get more reporting later on in the next week or so. We'll hear from Alphabet tomorrow. Look out for that. Tesla and IBM in the mix too. Intel on Thursday, they'll be in focus. GM already out this morning. GM would have beaten a race. GM would have beaten a raise. The numbers for corporate America feel absolutely fantastic.
They're holding on, and not just that, the bar has been high, and a lot of them have been clearing it. So GM, a fantastic quarter for them. When it comes to what's going down the rest of the week, you pulled the big boy earnings. It's true. Alphabet and Intel are going to be so important. And I think even now more so after this report out of Japan on what TSMC is doing. They are looking at raising prices by 10% for 2027. The hyperscalers are going to have to make sure that they can restart spending.
Well, it's great. Pricing power is pretty incredible for a handful of names right now. Equity features on the S&P, no session highs up by 0.5%. Coming up this hour, we'll catch up with Emily Rowland of Manulife on why earnings remain the key driver for markets. Ariana Salvatore of Morgan Stanley, its US and Iranian forces exchange strikes for a 10th consecutive day, and Ted Morrison of Baird as TSMC is reportedly planning to raise prices by up to 10% in the next year. We begin this out with stocks rising as investors begin shifting focus back towards mega cap earnings this week. Emily Rowland of Manulife writing, stock returns may not match the gains of the past 3 to 5 years, but earnings remain the fairway. Investors may need to become more comfortable taking the full swing with growth assets over the long run. Emily joins us now for more. Emily, appreciate the golf analogy. It's good to see you. Let's get into the market and we'll focus on that. Earnings have been fantastic. The bar's crept higher. Why do you think the bar is not too high this earnings season?
Yeah, companies have proven that they can surpass that bar. But the problem, John, now is that the earnings are amazing story is already an old story. All you have to do is turn it to Bloomberg surveillance to hear it. And now it's like, don't let me down. And we have seen companies absolutely crush it down the fairway. You know, we're 10% through earnings season, 51% earnings growth. Like that is amazing. You look at financials so far, we're looking at 36% earnings growth. The bar was 5% to start the quarter, but we are seeing some company-specific challenges. They're not necessarily related to the macro environment, but if companies are disappointing, they're issuing guidance that's not favorable, you're seeing those stock prices punished. So the bar is high, but so far so good in terms of surpassing it.
IBM is a good example of that, maybe a rare example of that, but if you miss, you'll get obliterated in this stock market. If you won, you will get absolutely crushed. Emily, what do you think the setup is for individual parts of the tech sector then in the next week? What are the parts of the market you're worried about? The parts of the sector you're pretty constructive on?
Yeah, it's going to be absolutely critical over the next couple of weeks to see these heavy hitters in the tech space. You know, semis have continued to just throw up these amazing earnings. We're looking at 100% earnings growth quarter after quarter. It's really just remarkable. And prices are reflecting that. So we're watching things like the Kospi index right now to see how these South Korean exports are faring. You look at South Korean exports right now, they're up about 70% year over year. That is a record. And that is telling us that demand remains exceptionally strong. But can prices keep up with that? Some of these moves have been absolutely parabolic. So again, that bar has to be met.
We look at the large cap growth space, some of those big hyperscaler names, they haven't seen quite the same price appreciation. So in that case, the bar may be a little bit more manageable here. But overall, 50% earnings growth in the tech space, that is a really high bar. I like looking at places that have a lower bar. Industrials, for example, expected to see less than 10% earnings growth this quarter. Again, financials, the 5% expected. We are looking to some of those sectors. Healthcare is another one where the bar is very reasonable. And those are areas we are looking at in order to diversify from some of those elevated expectations within technology.
When you're looking at diversifying, though, and you see elevated crude prices, potentially, does that worry you?
It does in some cases. And, theoretically, the idea is that you should see some multiple compression if oil prices keep rising and the cost of capital becomes prohibitive. But we've looked at what happens in higher inflation regimes to stocks. And in a 3 to 4% inflation regime, that's actually the sweet spot. Companies are able to raise prices right now. We're seeing that in some of the earnings results and some of the guidance that's out there. In particular, mid-cap stocks and value stocks tend to do particularly well during those higher inflation regimes. I would say, Anne-Marie, it's all fun and games until the Fed has to pump the brakes. And right now, inflation is not hot enough to really see the Fed doing that. You look at the softer employment report, you look at the lowest CPI data that we've seen in 6 years, that doesn't exactly scream Fed hike. But if oil prices do remain elevated, that risk comes back into the table. And that's frankly when the party starts to look like it may be over.
But you hear from the likes of Cleveland Fed President Beth Hammack saying that businesses, consumers are actually going to her and saying, you guys need to do something about inflation. Does that make you nervous that at some point in the next few months, the Fed will end up having to hike interest rates?
It does, it's certainly on the table. And that's the biggest concern we have, because right now we have these two mega forces colliding of central banks, becoming a little bit more hawkish at the margin at the same time that there's this massive need for liquidity with this huge AI earnings boom. So those two things coming together are really critical here. But when we look underneath the hood of the inflation reports that we're dealing with, yes, PPI was a little bit hotter. I would say that probably isn't necessarily a bad thing because it means businesses and manufacturing is booming in the United States. But the key to us is looking at shelter. It's all about shelter. Housing is the economic cycle. And if you looked at that last CPI report, shelter was up 0.1% year over year. That is remarkably low, and it's finally starting to reflect some of the real-time data that we're watching within the housing market. The NAHB on housing market index slowed to its lowest level in years the other day. Home builder sentiment is slowing, et cetera. So we think that can keep feeding into the inflation. It's 35% of CPI. So we think that slowing shelter component, which, look, mortgage rates still 6-7%, that is not helping the housing market recover. That can help dampen any inflation that we see coming from higher oil prices or from the good side of the economy.
Emily, this is the challenge this Federal Reserve has got. The drivers of inflation right now are arguably rate insensitive. And if they hike, it's going to pick a bad phrase. I'll pick a different one. They're arguably just whistling in the wind. I don't think, Emily, it makes much of a difference.
No, and I think that's why it's so notable that Warsh has said that these things are mutually exclusive. The employment side of the mandate and the inflation side of the mandate. That's a very different tone than what we've seen historically. And we think that that doesn't necessarily play out because if the Fed does hike, they're not really solving the supply side problem. There's not much the Fed can do on that front, and they may risk the employment side of their mandate if this cost of capital becomes higher and company margins potentially get compressed. It's not our base case. Margins are great. Earnings are phenomenal, like we've talked about. But if that cost of capital goes up, that is the Fed that's going to really kind of be pulling the punch bowl away from the party.
Whistling in the wind is difficult. Emily, thank you. Appreciate it.
Yeah.
Emily Ronan of Manulife, John Hancock Investments. I was going to say something else. The other thing, you mentioned Cleveland Fed President Beth Hammack a few times. I want to share this quote with our audience. This was in a LinkedIn statement going into the weekend. There is no conflict in our mandate. Inflation is too high. The labor market is right around my level of maximum employment. Then the line you mentioned. For the first time in my tenure, I'm hearing from businesses who say they think we need to take action to curb inflation. That's the push, the pressure they're under. at a regional Fed right now?
And that's pretty direct. You hear a lot of Fed officials talk about weighing the risks, upsides and downsides. What you hear from Beth Hammack is business executives are coming to me and telling me to fix it, and that they just see inflation as the sole problem right now. And that is her posture going into next week when they have this big family fight at the Federal Reserve.
Which might result in some dissent. Few voting members, including Beth Hammack, increasingly hawkish, even with that downside surprise on CPI just a week ago. Bond yields this morning around 420 at the front end of the curve. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John, thank you. Officials from Iran are reportedly meeting with mediators. The Associated Press reporting the meetings are taking place today in Pakistan. Reuters reporting a 10-day ceasefire has been suggested. The US and China are planning AI talks in September. Reuters reporting Treasury Secretary Scott Bessent will be leading the US delegation. The talks are set to take place before Chinese President Xi Jinping visits the White House later in the month. And JP Morgan CEO Jamie Dimon reiterating his criticism of the UK's bank tax surcharge. Dimon saying the tax hikes could drive capital away as they lead to an uncompetitive tax system. He says UK politicians should be worried about the number of companies that have delisted from London in recent years. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the program, continued escalation.
Iran is very much intent. They want very much to make a deal. We're going to win one way or the other.
We're just ending it. We control the Strait. They don't control anything.
Up next, we'll catch up with Ariana Salvatore of Morgan Stanley from New York City this morning. Good morning.
When news spreads, if redhead across the Bloomberg terminal, Bloomberg has you covered.
Trump's global tariffs are struck down by the US Supreme Court.
For all the context and clarity you need,
There's going to be now tons of tariff headlines until midterm elections.
hear it first on Bloomberg.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is. I'm Haslinda Amin in Singapore. I'm Menika Doshi in Mumbai. Welcome to
Imagine the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Imagine on your favorite podcast platform today.
Good morning. This is Bloomberg Surveillance.
Welcome back to the Opening Trade.
It's Bloomberg money.
This is the Your Trade.
This is Wall Street. We welcome the balance of power.
We're watching Bloomberg Deals.
Listen to Bloomberg this weekend. This is Bloomberg Television.
So it was a struggle yesterday, a struggle to bounce from 2 days of losses to kick off this trading week, and it became a third day of losses on the S&P. Here's the bounce so far this morning. We'll see if it holds. We'll see if it sticks. Equity futures so far in the S&P up by 0.5. Some outperformance on the Nasdaq. The Nasdaq 100 higher by 1.3. In the bond market, I've mentioned this a few times. Twos closing above 420 for the first time since we received CPI last week. Downside surprising, yet we give up the rally in the bond market. Twos back to 420, north of that level of 420.85. This in the commodity market is not helping. Brent crude, WTI. We talked about the monster drawdown in global inventories. Global inventories between March and May dropping some 360 million barrels. That's the cushion for crude. When you speak to professionals in this sector right now, they'll be telling you, we don't consume crude. You consume crude product, and we have bigger issues with crude product.
Yeah, a lot of risks out there when it comes to crude product, including if the Houthis were to get involved, and we would see potentially some hits in the Red Sea. What is going on in Russia in terms of export ban on diesel? The fact that China is still hoarding product, and a viewer writes in and says, "Look what's going on at Strategic Black Sea Oil Terminal." The fact that now they're having to halt some exports there because of Ukrainian drone strikes. There are a pocket of risks around the world that is putting tremendous amount of pressure right now on the product market.
It's not talked about enough. Developments in Russia, the export of diesel, right? Banned in the last few weeks or so.
It's a big deal.
That's kind of a big impact.
A massive impact because Russia normally would be exporting a lot of this to the global market. And right now, what they're seeing in terms of Ukrainian drone strikes on refineries, what's being into Russian territory, and people are lining up. If you look at individuals in Russia and they send you some pictures, you see individuals lining up at gas stations. There's some to cut off these exports at the moment.
Just been this quiet, uncomfortable rally on crude. We sold off at one point on Brent. I'm talking about Brent. We were threatening to break into the 60s, and now we're back in the 90s, just like that, very quickly. $90, 35 cents. Under surveillance this morning, continued escalation.
And they're looking very much intact and want very much to make a deal. We're going to win one way or the other. To me, I think it's over. I don't want to deal with anything with this scum.
It's a far bigger job that we're doing. We're just ending it. We control the exchange. They don't control anything.
So here's the latest this morning. Crude prices hovering around $90 a barrel as US and Iranian forces exchange strikes for a 10th consecutive day. The Associated Press reporting that mediators and Iranian officials are meeting in Pakistan right now, while Reuters is saying a 10-day ceasefire has already been suggested. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John, good morning. Well, for getting these signs that mediators are actively working to prevent further escalation, though a White House official tells us that the U.S. strikes are expected to continue until President Trump chooses a different course of action. And at this point, we've gotten very few public indications that Iran is willing to let up its leverage when it comes to the threat of attacking another tanker overnight, this time linked to Kuwait. There's new data out from research from Kepler that finds the average amount of ships transiting from Friday to Sunday was about 10 vessels per day, and most of them, if not all of them, use the route that is being approved by Iran and not that U.S. coordinated route that is closer to Oman. Now, just compounding the risks, as we've been discussing on this program, is the threat from the Iranian-backed Houthi rebels to institute this immediate maritime blockade of Saudi Arabia, as we know that the country has been using its pipeline to get more supply to market via the Red Sea to the tune of about 4.5 million barrels per day since the conflict began. And Saudi Arabia is taking the threat seriously, saying in a statement overnight that they will take, quote, all necessary measures to protect its ships. Now, John, as regional allies are working to try to get some sort of resolution, we got this new reporting this morning that Iran's president says that he's in closer touch with the country's supreme leader, which some experts say can help smooth the path for developments.
Tyler Kendall with the latest. Tyler, thank you. I want to pick up on that last line. If Lisa was here, she'd ask a question she often asks. When we negotiate, who are we negotiating with? I think that last line from Tyler was important.
Yeah, and also it's very odd because we have not seen Mustafa Khamenei. We have not seen the new supreme leader. And now you have the president, which is very domestically focused in Iran, saying, oh, well, I have a lot of contact with him. Well, do you? This is where the questions really come from. At the same time, there's been a lot of analysts in the U.S. government that they say they see evidence of potentially a debate taking place within the regime. Is that properly happening? Is there a real debate between hardliners and then those that maybe want to go to the negotiation?
It's the take from Ariana Sabato and the team over at Morgan Stanley about the following. We see the straight normalization requiring 65% of flows to get markets back to balance, keeping our oil forecasts above conflict levels, but below $90 a barrel. Ariana joins us now for more. Ariana, good morning. It's good to see you. Let's talk about those negotiations. I'll ask that question to you. Who are we negotiating with?
Good question. I mean, that's one of the key uncertainties when it comes to the implementation and seeing through the memorandum of understanding. Maybe just to back up and throw a little context, maybe why we're not necessarily surprised that this MOU sort of fell apart, right? We saw 4 clear paths to escalation after it was signed. First, implementation, and not just implementation, but sequencing. What happens first? Lifting the blockade, opening the strait. How do you lift decades of sanctions and reverse that policy? So that's the first question. Second question is, where are the Israeli and US objectives diverging, right? That's a really important component to keep track of. For Israel, the Strait of Hormuz doesn't matter as much, right? For the US, that's obviously a key concern. Israel's more concerned with missile launcher capacity, nuclear, as you could guess. The third, where is Congress in all of this? We know that there are some hawkish members of Congress that have pushed back against the deal itself, saying it wasn't good enough, didn't go far enough, and they will not have an explicit role in approving whatever MOU comes forward, nor did they approve JCPOA, the 2015 deal. But we are getting NDAA discussions going in Congress. So to the extent that lawmakers want to push back and make their preferences known, they'll have a platform to do so. The last thing I would say is on nuclear itself. This was a 60-day agreement. And the last time we saw nuclear negotiations, they took something like 20 months. So with that backdrop, it's not necessarily surprising to us that we saw this type of escalation. Who are they negotiating with? It's just one question among many.
And we're in the 60 days technically, and already we're back to what honestly is war, 10 days of strikes. Do you track where the oil price is going depending on what the president is going to do next? Is there a threshold for him that then potentially he says, okay, I'm going to leave into the diplomatic route?
It's very hard to see where those incentives might overlap. When we think of this from the domestic standpoint, it's really gas prices, right? Obviously, affordability, key issue heading into the elections. And when we look back at prior elections, it's not a perfect, rule of thumb, but one thing we go by is the 3, 4, 5 rule. So gas national average around $3, good for the incumbent, right? $4 politically a little bit dangerous. 5 plus, that incumbent is likely to lose that election. So I think if there is a metric to track, that would be it, right? But overall, I think there are many incentives that are sort of driving the president's strategy here. And as you guys said before, you don't consume crude, right? It's just one factor of it.
What are the policy proposals that potentially this administration or Congress are going to look at if we continuously march higher from $4 a gallon?
I think a lot of the options have been on the table since the start of the conflict back in the spring of this year. The clearest things, temporary sanctions relief, right? So that was not just for Iranian oil that was on the water, but also some Russian oil, so secondary sanctions too. You saw a Jones Act waiver. You saw capping of the strategic petroleum reserve, right? Those levels are low relative to where they started in the conflict. But again, these are all mitigation measures. They're not really going to be enough to meaningfully offset this sort of increase.
I know this is a difficult question to answer, but do you get the sense that maybe this situation is more important to the president than the midterms? We often have guests that come on the program and talk about the midterm, kind of get this down with before the midterms. Does he?
I absolutely think this is not the primary concern. The midterm is not the primary concern for President Trump. As we've said on this program before, there's plenty that remains within his control following the midterm elections, right? So tariffs, geopolitics, foreign policy, immigration controls, all that he can continue doing. And the historical precedent suggests the Democrats are probably going to do pretty well anyway. So if you think about that, I think the bar is relatively lower for President Trump in terms of keeping House control, keeping Senate control. I think that that's not the only thing he's considering when it comes to the conflict.
Ariana, it's good to see you. Thanks for being here. Thank you. Ariana Salvatore of Morgan Stanley. That last night, I think is important. We often hear that. He'll get this fixed because he has to before the midterm. Does he?
I'm looking at that quote he said a few months ago, not even a little bit. The president said when asked to what extent America's financial situation were motivating him to make a deal with Iran. The only thing that matters when I'm talking about Iran is they can't have a nuclear weapon. Not saying he doesn't care about Americans' financial situation. It's just that he cares about this a lot more. And he's not going to let Americans' financial situation, potentially higher gas prices, impact what he wants to do with Iran. At the same time, we have seen this president definitely move towards wanting to take diplomatic route when available.
That's the bias of the market too. And when you're confronted with two-way risks like we are this morning, the prospect of the Houthis shutting down the Red Sea and blocking Saudi Arabian shipping, or the proposal for the 10-day ceasefire, the market will put more weight on the latter than the former, precisely for that reason.
And I lived it in real time with the president in Turkey. In the morning, he started out on the final day saying the ceasefire is over. They started bombing once again Iran. Then when we came to the press conference at the end of the day and reporters were asking, we're back to all-out war. He would not commit to that. He said it wouldn't be a long time.
Crude at 90, WTI around 85. Up next, we'll catch up with Ted Morrison of Baird, as TSMC is reportedly planning to raise prices by up to 10%. Plus, Shihara has your morning movers. Software stocks falling across the board following a series of downgrades.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell,
With deep analysis of the forces driving the price action.
focusing investors on what really matters.
Where the money flows, which markets are changing.
It's conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI. That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
A pretty spectacular story.
This is the future. This is the 21st century economy.
The transactions
Snapped up nearly $1 billion of Bitcoin.
and the technology.
We need to build digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
And extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
This is the equity market picture so far this morning. Then good morning to you. Equity futures on the S&P bouncing back, on the S&P higher by 0.4, on the Nasdaq up by 1.2. The bar for earnings is sky high. The earnings continue in the next 24 hours. GM, we'll talk about that in a moment. A beat and a raise from General Motors earlier on this morning. Name the bank in the last several months, they've probably upgraded their price target on the S&P 500 from Goldman to JP Morgan, from RBC to UBS on the back of very, very positive earnings. This came from Matt Kerner of HSBC. Here's the warning. A man who has been very bullish on this market for a long time. He said it may well be time to reduce risk in portfolios after the peak earnings season in 2 weeks' time. Is this as good as it gets?
He was talking about positioning being more stretched when he was on Bloomberg earlier today. And then he says, when do you get out? That's really hard to time right now. And that's what a lot of individuals are dealing with right now. And on top of that, you have a lot of risks coming into the market. We have 3 today. The market is digesting or potentially been shrugging off when it comes to Iran. More tariff talk of this White House, this time on Canada. And then, of course, TSMC raising prices going into 2027.
Max Kerner joining the program tomorrow morning, 6 a.m. Eastern time. Don't miss that. Let's turn to the bond market. Switch up the board. 2s, 10s, 30s. Yields look like this. Here's your yield curve stateside. 2s at 420.64. 10s around 460. 30s around 5%. How many times have you heard me say that in the last few weeks? I've said it repeatedly because this bond market has been very, very range bound with yields at the upper end of the range. The why? Many reasons. Here's one. Check out crude. The bounce back we've seen in crude, it's been quiet, it's been stealthy, but you've gone from the 60s on WTI to 85. You've gone from the low 70s on Brent into the 90s. You're talking about a $20 move in some cases very, very quickly in this energy market.
Sometimes you would see these moves across a number of years, not just weeks. And this is all stemming from the conflict in the Middle East. And when it comes to Iran and Washington right now, the main focal point on what they are trying to get control over is who controls the Strait of Hormuz. And that is why we've had this breakdown in the 60-day MOU. Potentially there's an off-ramp for a 10-day ceasefire, or potentially this messy situation gets a whole lot worse if the Houthis come well on their threat and start to block some of the product and crude that is going through the Red Sea.
A 15% plus rally on crude just last week, up again this morning. 2 hours away from the cash open. Let's get to your morning move. Shahira has more. Hey, Shahira.
Hi, John. We start with the earnings that we've gotten this morning, and GM shares up 1.6% in the pre-market after the automaker posted a beat and a raise thanks to its strong pricing on its more profitable trucks and its cost-cutting measures. But I will note that shares were in the red earlier, underscoring some of the concerns that investors have with this automaker. U.S. car sales are still declining. Plus, the company is relying more on pricing power rather than seeing stronger demand for its trucks. Meanwhile, another company to report earnings is the credit reporting company Equifax, and shares are plunging 11% in the pre-market after it struck a more relatively low in the top forecasted investors are punishing it for that, even though it beats on second quarter earnings. And we end on the software stocks. They are under pressure with names like Salesforce down nearly 4% in the pre-market after Morgan Stanley have downgraded a number of them. The call reflects a broader shift in sentiment that we've seen in software, where investors want more proof that their investments in AI are translating into actual growth. And Morgan Stanley says that it is not seeing that with these names, even though they all have a big AI push. And I will note, Intuit shares down 53% year to date, John.
Brutal stuff. Cutting up. Yahara, thank you. Appreciate the update. More from Yahara in our next hour. On our radar this morning, day 10 of direct strikes between the US and Iran. Ceasefire talks are reportedly underway, with the Associated Press this morning saying an Iranian official is meeting with mediators in Pakistan. Reuters reporting a 10-day pause has been suggested. Elsewhere, the president threatening a fresh 50% tariff on a range of Canadian goods. Washington highlighting unfair treatment of American products as reasoning for the levies. The tariffs are set to take effect in 30 days should the president follow through. And finally, General Motors rising in the pre-market. The automaker exceeding estimates for the second quarter and raising its full-year earnings forecast. The GM CFO, Paul Jacobson, joining the program at 8 a.m., so about 30 minutes from now, to break down the numbers.
I'm really excited to speak to him because there's so many issues right now affecting GM and whether or not you're a massive automaker in the world. I mean, you wake up this morning, you see fresh tariff headlines between Canada. I know it's not affecting autos right now, but you have to think that this potentially going to be a problem given the United States, Mexico, and Canada are renegotiating USMCA. You have the fact that they have had EV losses. What's going on with that business? And the fact of the matter is, it comes down to people want pickup trucks and SUVs, and they have been having very aggressive pricing on that, and it's working for them.
Let's start with that last point. It's important. They've got pricing power for premium trucks. That's fantastic. At a time when gasoline prices are pushing higher and doesn't seem to be slowing sales right now, they've increased the guide. We'll start there, I think, for the conversation. The powering of margins, the engines for margin growth right now, they seem to be very constructive on that. I think we need to get into that too. You talked about tariffs, high chip prices, another factor as well. They're going in the wrong direction too. So trying to work out how this company has navigated these issues really quite well in the last 12 months, how they plan to do the same again over the next 12.
It costs a lot of money to fill up an SUV and a pickup truck. And if gasoline prices are going higher, is there a threshold where potentially they would have to not raise prices anymore? Or potentially, will they see pushback from consumers? We know they're not interested in straight EVs. Potentially, is there more of an increase they see on the horizon for hybrids? Or are people just going to put off buying brand new cars?
So based on the numbers we're seeing this morning, we're not there yet. GM this morning higher by 1.7%. Looking forward to the conversation with the GM CFO in 30 minutes' time. Let's turn to tech. Taiwan Semi reportedly planning to raise chip making prices by up to 10%, according to Nikkei. The changes will take effect next year and cover both advanced and mature semiconductors. Ted Morrison of Baird writing, we're at the front end of a super cycle, but the spend and funding requirements are massive. Ted joins us now for more. Ted, good morning. Good to see you. The spending and funding requirements are huge, and these companies, a handful of them, are making massive, massive profits. Ted, to your point, and you've noted it in the note you've put out, sent over to us, we've seen great numbers from Taiwan Semi. We've seen great numbers from Samsung, from Micron. What does the market response to those great numbers tell you about how high the bar is this earnings season?
The bar is extremely high, and all these companies have got to absolutely annihilate the number, like Vicor just annihilated the number this morning. The issue, I think, is a little bit different. If you look at TSM, they increased their capex from 56 billion to 62 billion. To put that in perspective, capex in 25 was roughly 41 billion. On their call, they did indicate that some of that increase was due to higher equipment costs. So they're seeing the inflationary impact on their model already. So they've got to pass on all these additional prices. And from my perspective, I think this is a blind side on the tech market. If you look at the 10-year Treasury at 4.6%, if we lose control in the long end, I think cost of capital issues will become front and center with the street.
So let's get into that. You've mentioned this the last time we spoke as well. The long end of the curve, at times over the last few years, has had these moments where it's felt untethered. Are we close to that moment now? And can you just build out what is the relationship between that and the things we're talking about in tech?
So we're not playing chess on 4 levels anymore. We're playing chess on 10. This is probably one of the toughest markets I've seen on trying to balance the macro inputs. If you look at oil at $90, that's massively inflationary. If you look at the semi trade, just the AI infrastructure build, the demand on memory, for example, due to the impact on inference and the memory loadings, has been biblical. We have never seen a 300% plus increase in memory. So we're seeing price increases everywhere in the semi-food chain, and they're significant. Memory I touched upon, there's 25 companies that are seeing their gross margin being hit by memory. Second of all, if you look at advanced logic, what TSM does, they derive about 33% of their wafer revenue from the 3 and 2 nanometer nodes. This is where manufacturing is going. And they're the only game in town right now at 2 nanometer. It's de minimis as it relates to their total revenue, but it's going to be a massive manufacturing node. For them to raise prices here, I guarantee you, in the boardrooms of NVIDIA, Apple, Qualcomm, AMD, I'm sure they saw this coming, but they've got to pass on these costs. And at some point, we have the discussion of elasticity of demand.
So Ted, let's get into what it means for fixed income more broadly, and we'll start there, and then we can talk about the potential for demand destruction further downstream. This is what I've been thinking about. I know you've given it thought as well. These companies are spending tremendous amount of money. Clearly, it's creating inflation pressure, price pressure that needs to be absorbed somewhere by someone. That threatens to push up on yields, might threaten to push up interest rates of certain central banks as well. But at the same time, we've got these massive funding requirements, financing needs of companies coming to market, both through equity and through debt. The struggle I've got right now, Ted, is this put the squeeze on the treasury market? Does the treasury market put the squeeze on those financing requirements? Is the tail wagging the dog wagging the tail? Which one is it?
I don't think we've ever been here before, to be honest with you. I mean, I'm seeing estimates of 1.4 trillion of funding next year. We've never been here before. This is a totally different cycle. And when you've been doing this as long as I have, you always try to look around the corner of what's new, and that is new. That funding requirement is not bigger than a bread basket. It's the bakery. It is massive. So what I'm watching very closely, and I talk to portfolio managers sometimes 3 times a day, and what they're struggling with is attribution. And the worst thing that could ever happen to the tech tank is if we lose control of the 10-year, and let's just say hypothetically we go to 480 or even 5% worst case, there's going to be sector rotation. Look at the chart of Marathon Petroleum, and I am not an energy guy, but it's probably one of the strongest charts that you've ever seen. That's the definition of sector rotation. So what I'm watching going into Q2 earnings, all of these semi prints are going to be massive. They should be. That's number one. Number two, if you look at Micron, if you look at TSM, you look at Samsung as the underlying company, they blew off the number like nobody had seen before, and the stock traded down. If we get into the sell on the news on price perfection, there is going to be sector rotation. And where I'm watching very, very closely is if my PMs decide that, hey, I need to own energy, I need to own consumer staples, I need to own utilities, I need to move away a little bit from tech. The issue, Jonathan, is if you look past April 7, the majority of the semi increases of 66%. I mean, that's a good couple of years of performance in 3 months. The exponential increase on performance on the upside was historic. If we get sector rotation, my worry is it won't matter on fundamentals. If people move to different sectors, it's going to be a blind side for the general market if we lose control of the bond market.
Ted, layer that on top of the fact that we are seeing political pushback as well when it comes to AI data centers and potentially cheaper models coming out of China.
The investments that were made on OpenAI and Anthropic were done on the front end of the curve. I'd have your viewers go and do a deep dive on the partnership that Palantir and NVIDIA did. This is the definition of decrease in token prices via open source models, silicon, and the next generation stack middleware. You may love or you may hate Dr. Karp, but the guy's brilliant. And whenever he gets criticized, he's generally right. So the models are changing. Enterprises need lower token prices. They also need open source models that are not compromising their businesses. And this is what Dr. Karp went into great detail on a few weeks ago. So not only do we have a constant churn of the infrastructure changing, but I think you have to also look at how we are going to attain revenue, in the trillions to make up for this cost. There are three markets. I'll be very short. One is consumer. That's dead in the water. If you look at enterprise, that's 4% enterprise budget increases. Costs are up 25%. My clients are worried about the second half. And then you got the hyperscalers. They're spending like drunken sailors, and they will until they have to because they can pass on costs. Where we run into a problem is that the end customer just can't take it anymore. And we'll have to watch that in Q2 commentary.
Ted, after a conversation like that, forgive me for asking such a simple question.